Why diversification didn't work the way you expected. If you invested through 2008 or even to 2020, you may remember something surprising. It wasn't just that markets fell. It was that things you thought were diversified started moving together. Stocks down, bonds down. Assets that were supposed to offset each other didn't feel like they did. For many investors, that moment was panic. It was confusion. Most of us are taught that diversification solves risk. Own different asset classes, spread exposure across sectors, balance growth and stability, and in normal markets, that works. But diversification behaves differently under stress. Because under stress, something else takes over: liquidity. Here's what happens. In calm markets, assets often move independently. But during periods of systemic stress, correlations tend to rise. When investors across the system need liquidity at the same time, assets tied to the same financial infrastructure can move together, even if they're different on paper. It's not that diversification failed, it's that stress changes behavior, and behavior changes pricing. Think about it this way. If everyone in a theater calmly walks toward the exits, it works smoothly. If everyone rushes all at once, the system strains. Markets behave similarly. When liquidity becomes urgent, pricing can disconnect from fundamentals. It can lose temporarily. That's when diversification feels weaker than expected. The real lesson isn't don't diversify. It's understand that diversification alone doesn't guarantee stability under pressure. That's where structure starts to matter. Questions like, how is this investment priced? Who controls liquidity? Is this asset dependent on daily market sentiment? What drives its demand in the real world? Those questions rarely get asked in traditional portfolio construction, but they matter during stress. This is one reason many experienced investors begin to incorporate assets that operate outside of traditional market pricing, not to replace stocks or bonds, but to balance behavior. Assets tied to real demand, housing, storage, production, energy, they don't always move in locksteps with financial markets. They still carry risk, but they're driven by use, not just sentiment. That difference matters during stress. Diversification is still important, but it's not just about labels. It's about structure. It's about behavior under pressure. And it's about building portfolios that can function even when the system is strained. Because markets will be tested again. The question is whether your portfolio is built only for calm or for stress. I explore more of this deeply in my ebook, The Crash Doesn't Announce Itself. If you'd like to go further into this framework, click the link below.